Oil prices are not going back to the $60, $65 range. 80, 85 is the new 60, 65. It's going to prolong what I believe is a commodity bull market that we're currently in.
If the U.S. wants out of the Iran war, what does that mean for energy and commodities? I wonder if it's as easy as war over, markets higher.
This is going to be much more of a process of normalization rather than a snap your finger.
We speak with veteran investor Peter Boockvar of One Point BFG Wealth Partners, which manages $16 billion in assets.
The hyperscalers, the Mag 7 stocks, and generally the Gen AI tech trade, it's been spectacular, but I think it's losing steam.
Do you have broader concerns about things like private credit? There's war, there should be a flight to safety, and yet gold pulled back. How do you explain that? Some are trading at multi-year lows. Why do you want to scoop them up here?
So this is by my own personal pain trade.
We all have them, don't worry. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof. From tax and estate planning to trust services for generational wealth and strategies for life's key milestones like buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James advisors unique is their complete independence. With no proprietary product to promote, you will benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $100 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca. The content provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult with a qualified financial advisor or professional before making any investment decisions. Hey everyone, welcome to another episode of In the Money with Amber Kanwar. On this episode, we've got Peter Boockvar. He's the Chief Investment Officer at One Point BFG Wealth Partners. They manage $16 billion in assets, and this conversation is coming at a really interesting point for the markets. The market is very clearly telling us they want this war to end. Anytime the U.S. administration signals that it's weeks away or that they would walk away without certain criteria being met, you get this rip-roaring rally in the markets. And it's going some way to undoing what has been a very damaging start to 2026. The S&P 500 just put in its worst quarterly performance since 2022. The NASDAQ fell 7% in the quarter. The TSX, we do have energy, but gold fell. So for the month of March, we had the worst performance in 3 years, the worst monthly performance, I should say, in 3 years. But in some ways, we've been here before. The quarterly loss on the S&P 500 of 4.6% is nearly identical to the quarterly loss this time last year. Last time was tariffs, this time is war. What is the setup going forward? Now, Boockvar is not recommending you go out and you chase tech. He does not think that that's going to lead the recovery. He says that commodities, assets outside of the United States are going to continue to be the leader, and we've seen that over the past year. We talk about what the long-term implications are of the Iran war. We also talk about the other anxieties that the market was contending with before that. He's got great insights on private credit. He says as a CIO, he was seeing about 10 private credit deals a week, and he explains why he never bit. And a man after my own heart, one of his highest conviction areas is a ignored, dirt cheap part of the market that is trading at multi-decade lows. That comes in Pro Picks. You're going to have to watch the whole episode for that. And hey, we're not doing our swag giveaway this month, but there's still many ways for you to be involved with the show. Every day I write a markets newsletter, And every time we do Pro Picks, I send it out straight to our subscribers. So if you want to be one of our subscribers, all you have to do, go to inthemoneypod.com, smash that subscribe button. Okay, let's get into this interview. Peter, thank you so much for joining me on the podcast.
Great to be here. Thanks, Amber.
Well, it has been a volatile couple of months, and we're at kind of what seems like a turning point for the markets. And I wonder if it's as easy as war over, markets higher.
Maybe in the short term, it's that easy, but I do think that it's important to look to see what was the state of things before the war, because some of those bigger issues, I think, will revert back to, in addition to trying to figure out what are the long-term implications of the war and the Strait and what that means for geopolitical premiums in a variety of different things.
Let's talk about that latter point first, the long-term implications of the war. I think it's very clear the U.S., just based on what they're saying, they don't want a prolonged war. They keep saying, oh, it's a couple of weeks. But the long-term implications, I think, are harder to assess. And it's not like tariffs, right? Tariffs is almost a switch. You turn it on, you turn it off. The damage to supply chains and people's perceived risk in the energy market, maybe not as easy to switch off. How are you thinking about what it looks like when this settles out?
Yeah, this is going to be much more of a process of normalization rather than a snap your finger. Let's just assume that the war is going to end within the next week. And I assume that because if regime change can happen, then you have to end the war at this point. The question, though, and then is what terms, who's going to control the Strait? Is it going to be freely open, and so on? But let's just assume that it's freely open. As long as the Iranian regime still remains in place, there's obviously going to be risk of any ship going through. While maybe it's safe right now, what happens if something happens again in the future and we have to go through this all over again? So I do think that oil prices are not going back to the $60, $65 range where it was before the war. I think 80, 85 is the new 60, 65. And I think also as part of that is you're going to have global stockpiling of crude oil. You're going to have global stockpiling of fertilizer and other critical minerals because no country is going to want to have to sit through a major supply disruption, whether it's the Strait, whether it's COVID, whether it's Russia invaded Ukraine or something else. So I do think that there's going to be sort of a bid underneath commodities. And I do think that it's going to prolong what I believe is a commodity bull market that we're currently in.
I mean, that's such a turn on its head from what we walked into in 2026, what everybody said about the oil markets, right? It was like, oh, massive supply glut. Maybe we even see a four handle. I had some guests coming on saying maybe we even see a four handle on oil before a recovery this year. I mean, that thesis totally off the table now?
Well, I was in January, February, arguing that $60 oil was one of the cheapest assets in the world. And that all this talk about a supply glut just wasn't in the data. There was a supply glut of oil on the water, on tankers that were sanctioned, but looking at inventory levels in totality, there was no global supply glut. If you look at the futures curve in February, we were in backwardation, no sign of a supply glut. You have the largest swing factor outside of OPEC, that being U.S. production, showing signs of a plateau of production. So I was not in the bear camp. I was in the bull camp. And obviously, having no idea that a war was going to start, we were buying oil and gas stocks.
Now, that's
prior to the war.
That's the question that I have. That turned out to be a great call. Oil and gas stocks, both in Canada and the U.S., ripped higher on these higher energy prices. Now, the question is, if oil goes from 100 down to, you say, 80, yes, that's higher than 60, but still a 20%, a $20, and 20% drop from where we are right now. Do oil stocks drop?
Yeah, they will in the short term. But oil stocks aren't right now, even with the rally, pricing in sustainably for $100 oil. Because investors are also looking at the futures curve, which I want to emphasize is not predictive. It's what people think today of maybe the future, but tomorrow that can change. So if we drop back to oil, yeah, there'll be a correction in oil stocks. Some of the fast money will come out of it, but the pullback is going to rest much higher than where they were pre-COVID pre-war. Because if you do settle into a new reality of higher prices, these stocks are going to do very well in terms of earnings and cash flow at $80 oil. And if we settle out at $100 oil, then it'll be even more pronounced to the upside, even from current levels.
I wanted to, you talked about a commodity bull market, and you're going to give us some specific ideas in pro picks, but at a high level, I'd love to talk about what that means for gold. Gold obviously has had a tremendous run, and we saw a pretty sharp pullback in March, which might have had many people scratching their head. There's war, there should be a flight to safety. War was a major catalyst when Russia invaded Ukraine. And yet gold pulled back. How do you explain that?
Well, we have to have it in the context of the rally that really began in 2022, not necessarily in response to the immediate war of Russia invading Ukraine, but it is what the US and the EU did to try to punish Russia in response to that by freezing half of their global central bank reserves. So by doing so, that encouraged every other central bank around the world to say, hey, if you can do that to Russia, well, maybe you're going to wake up and be angry with us and do that to our holdings of US dollar-based assets, maybe in treasuries. So we need to own more gold. So there's been voracious central bank buying in gold that culminated in a big rise in 2025 and a continuation of that in early 2026, where it almost went parabolic, particularly silver. So since that move, gold started to consolidate and digest that rally, silver as well. So then you throw in the beginning of the war, and you had going into it a lot of short dollar trades that were invested in non-dollar beneficiaries, like gold, like international stocks. And a lot of that unwound when you saw the dollar have this sharp rally. And also you had higher real rates. And then you also had concerns that a lot of those central banks that have been buying gold since 2022 in earnest were going to sell some of it to finance their own domestic needs because of the big spike in energy prices. We've seen that with Turkey, who did enter this gold swap because they wanted to take the dollars they brought in to boost the lira, which tanked after the war began. There was chatter that Poland was going to sell some gold to finance an increase in defense spending, even though they haven't officially sold any. So that has definitely been a concern of gold being a source of funds in this new situation that we're in right now with the war. So I think all that combines for that sell-off and that correction in gold. I still think when looking out over the next couple of years, gold is still in a bull market. I do think that it's come to be probably the most important central bank reserve out there as more and more transactions, particularly in oil and other commodities, and then further other goods take place in currencies outside the dollar. Gold is going to be sort of a settlement currency within that. So that's, to me, a bigger picture, longer term scenario. And as long as I think developed market debts and deficits still remain very excessive and likely central bank easiness in response to that, I think gold is going to do well, notwithstanding the pullback that we've currently seen and maybe continues. But I think anybody with a multi-year time horizon should take advantage of this pullback right now.
Do you see the kind of gains we've seen over the last couple of years repeating in future years?
No, I don't. I think a lot of the easy money's been made. I do think gold probably settles out at 7,500 to 10,000, and very well could go above that. But that's the level that I have in mind. So while it's still a nice move from current levels, from a percentage basis, I think a lot of the big moves have already taken place. So I think if you were to define it as a baseball game, Maybe we're in the seventh inning of this bull run, but still with a few innings left.
So you're a U.S. investor. You like gold. You like energy. You know that is not in abundance in the S&P 500. We're obviously sitting here in Canada. That's a big part of our index. Are you going global for your exposure to those areas?
Yes, I mean I've always been a global investor. I've felt that I've always used this that 75% of the world's GDP takes place outside the U.S. and 96% of the world's population lives outside the U.S. So I think if you want to be an investor, you have to open up the world for your opportunities. So I've always been sort of geographically agnostic. But going into last year, I felt that the level of outperformance of U.S. markets relative to international had gotten just so extreme. If you look at post-World War II type historical references, that we were due for just some mean reversion. And we know that the dollar had one of its worst years on record going back to the 1970s last year, and that was certainly a catalyst for helping to close some of that valuation gap. And then, of course, tariffs and sort of the redirection of global trade and global capital flows helped to lift international markets off the lows. Now, of course, that got upset by the war with the rally in the dollar and the big sell-off in particularly Asian and European markets that those economies are highly sensitive to energy imports. But I do think that that over the next couple of years, international markets are still providing a lot of opportunities. And I do think that the dollar, when this war is over, is going to reassert itself to the downside relative to some other currencies, particularly the commodity currencies, and will provide another opportunity for those looking overseas to buy things.
Okay, so maybe U.S. underperformance relative to commodities and international markets, and you're right, that has been a winning strategy for.
And I'm sorry,
Yeah,
Amber, I just want to add one more thing to that. We know that a big reason for the U.S. outperformance relative to everything else over the last 10, 15 years has been U.S. tech. I'm of the opinion that the hyperscalers, the Mag 7 stocks, and generally the Gen AI tech trade, it's been spectacular, but I think it's losing steam. And particularly with the hyperscalers and their deteriorating cash flows and the growing competition, even for names like NVIDIA, where investors are beginning to question whether they can sustain their current profit margins. So I think if I'm right on this, and we continue to lose the AI tech trade in terms of leadership, well, then that gives even further reason for international markets to outperform the U.S. because of the high concentration of the Mag 7 and Gen AI stocks as a percent of the S&P 500.
Okay, so let's have some fun here. We'll push back on some of that thesis, particularly on the S&P 500. Basically this time last year, Peter, you know this, we were sitting at a similar situation. We were sitting at a quarterly loss for the U.S. markets, and then it went on to stage a tremendous recovery, and tech was part of that. And then you look at factors like earnings estimates. Those are still implying, and you could pick that apart. You can say, well, actually, those earnings estimates are wrong, but they're still implying that growth remains intact. It's almost, a near virtual setup to last year. What's to say that the same thing, the same stunning recovery in markets can't happen again for the rest of this year?
Yes, I never want to discount that scenario. Last year, we know we had in January, late January, the DeepSeek news that really sort of shook the tech tree. And then, of course, we had the early April tariffs that were on and then off. And then we had that big rally after that. And sort of that AI tech trade got a second wind through the summer. I think the bells started to ring, though, on that trade when Oracle reported, I think it was their July quarter, where after the prior quarter rallying to north of 300 on the big news with OpenAI, the stock started to really get hit because of worries about their overexposure to OpenAI and the huge amount of capital spending that they were doing. And then the September quarter, we saw a repeat of that. And the stock actually, I'm sorry, maybe it was the July quarter that we had the big rally, then the September quarter got hit, and then the January quarter got hit again. So that was sort of the first sign that, hey, you've gone from, and I'm talking about Oracle specifically, gone from 10% of revenue on capex to now 75% of your revenue on capex. Wow, it's eating up all of your cash flow. We're going to re-rate you. And then, of course, we had questions about Meta and all their spend. They reported some phenomenal quarters, but the stocks traded down. I'm talking about the back half of last year and really the fourth quarter, but because investors focused on capex and then focused on Oracle's a huge amount of capex and Amazon and the competition between NVIDIA and Broadcom's making chips for Google's Google's TPUs, and they have Amazon's Trainium chips, adding some more competition. So that trade really began to falter in the late part of 2025. And then going into the war, Mag 7 was hugely lagging the equal weight S&P. So that was really my theme, is that level of underperformance relative to the rest of the S&P was noteworthy. Now, luckily, the market passed the baton onto other things. And then, of course, you have the war that's changing everything. But I do think when the war is over, we're going to go back to those capex concerns, and the market's going to try to find other things to rally.
Don't you think they've been punished enough for capex concerns? We've got shares of, let's leave Oracle aside, because I think it's different in terms of, debt profile and an exposure to OpenAI, or at least you can make that argument. But NVIDIA, Meta, Microsoft, they are trading at multiples, 20 times, 19 times earnings. Can you not make the argument that all of that thesis has played out? When was the last time that you could buy, a stock like an NVIDIA, 21 times earnings, projected to grow sales at 70%, bottom line's going to double, just blowing out free cash flow, hundreds of billions of dollars of free cash flow. At what point do you say, okay, I'm ready to step in here?
So I'd actually rather step into like a Microsoft than an NVIDIA. My issue with NVIDIA is not the fundamentals. It's when people say, well, it's only trading at 21 times earnings. Well, that assumes that the 75% gross margin is sustainable. And never in the history of semiconductors is a high gross margin like that sustainable forever, because competition only intensifies. And if we're going to wake up one day and the hyperscalers are going to say, spending 50% of your revenue on this data center build out is probably not sustainable. And once those companies cut back on that capex, well, that's coming right out of NVIDIA's pocket. So that's where NVIDIA becomes more vulnerable. And I'd rather value NVIDIA on a price to sales basis rather than a price to earnings, because of what I believe is an unsustainable level of gross margin. Now, NVIDIA is a phenomenal company. I'm not shorting it. I'm just laying out what I still think is one of the reasons why the stock is no higher than it was last August.
Yeah.
Because investors are starting to ask these questions. And there's no doubt that these stocks have gotten cheaper. And the scenario that I talked about has been playing out. Now, where the bottom is, I just don't know. I just think that we're in a time where their level of leadership is dissipating. And maybe these stocks can still do okay, but over the next 5 to 10 years, this group of stocks is not leading the market, I believe. And I use history as a guide that you go through periods of dominance with a group of companies, and then we shift to another group of dominance. I'm not sure what that next group is going to be just yet, but I don't think it's these stocks that have been so spectacular, as I said, over the past 10 to 15 years and even, prior to that. So I just think we're in the midst of a major change in leadership that I think is, if for those that are relying just on those stocks for future returns, I think that they can find some better returns elsewhere, is, I guess, really my point, rather than trying to make a bear case here on them.
And that's a good point, because you have to think of the weighting, right? So much of the S&P is the tech sector. So you can be bullish on energy, but it's like 3%
right.
of the U.S. markets. But There was a lot of discussion about this rotation, right? Out of tech and into other areas. And it seemed like for a hot minute that was going to be financials. They came into the year, top of the world. And now they're at the bottom of the pile in 2026, even underperforming the tech sector. Some of it is related to tech, right? Because of exposure to private credit and software companies. What do you think about financials and its ability to get up off the mat? Do you have broader concerns about things like private credit?
Well, you're right. Banks were a beneficiary for a period of time in that rotation that came out of big cap tech. And I think you rightly point out that one of the concerns now is their exposure to private credit. Now, banks have provided a lot of these warehouse loans to private credit, and they are now being much more judicious in terms of the exposure they want to take from here. But also, are we on the cusp of a credit cycle? Are we on the cusp of an economic downturn in response to the spike in energy prices? We're certainly in an economic downturn in Europe and Asia because of their high exposure, but the U.S. is still very sensitive to global economic activity. So, if we are in the midst of a potential credit cycle or in the beginning of one, well, then you have to be more careful with banks. Now, banks, generally speaking, have pretty solid balance sheets and still generate a nice return on equity in terms of earnings and their balance sheet. And so I think that they could be fine stocks with decent dividends. But if we are again on the cusp of a down cycle in terms of credit, then they potentially could be vulnerable here.
I think that's the big question for investors. We had a previous guest talk about this, is the difference between a slowdown and a breakdown in private credit. Where do you think that this is going to shake out?
So I follow this closely. Being the CIO of a wealth management firm, you can only imagine that I've probably have been shown 10 deals a week for the past 2 years, all with the same pitch, with private credit trying to tap into that retail investor. So you have a couple of things here. A classic scenario of too much money chasing not enough good loans. It's a legitimate asset class. We know that the banks sort of seeded this area of the loan market post GFC and the tighter regulatory constraints that were put on their balance sheets. So naturally, private equity, private credit's going to step into that vacuum. But we know that the herd follows each other, and they all piled into software loans because they thought that the SaaS business, the subscription business, was a pretty consistent generator of cash flows, which, yeah, it is. However, classic lending, classic bank lending was, asset-based lending. Is I will lend you money, and you're going to show me collateral, whether it's a building or your personal guarantee. Now, we've turned lending into an asset-light industry that it's fine as long as those cash flows are strong. But if there's a distress situation, well, what kind of assets are owned and can be liquidated to pay back the borrowers? The lenders. So recovery rates for some of these loans are not going to be very high. Then you actually have the situation with retail. Okay, let's democratize this asset class, which on paper sounds great. Why should retail investors not get access to the same type of investment opportunities that institutional investors get allocated to? Which I get. However, the natural investor in terms of time horizon and liquidity needs is not retail for a private credit or private equity firm. It's endowments and pension funds and insurance companies that are hand in hand with those liquidity and time horizon constraints. But retail might say they are, and some retail maybe is. Some high net worth people that can allocate certain dollars of theirs and say, okay, don't worry, you can give me my money back over 5 to 10 years, I'm fine. But a lot of retail is not so nonchalant like that when things hit the fan. And when your neighbor retail is redeeming because they see problems where, well, you may redeem as well. So now you have this issue with private credit, where money's coming out, some money's coming in, but on a net basis, there's really no net flows. And if this downturn continues, you're going to see net outflows. And if you can have people leaving in 5% a quarter, well, that's 20% a year. And if that happens for a second year, well, what type of business are you going to have as a lender? That's why the bank industry is probably better, because you have these sticky deposits as long as you are a good steward of them, and you can lend it out and not have that same issue. Now, of course, you have bank runs, and I'm not saying that is a clean situation either, but that's the situation that private private capital and private credit and equity too are going to have to deal with by tapping into what I've always thought from the beginning was an unhealthy marriage between retail and private credit.
Yeah, take me into. So you said you're getting.
And wait, I'm sorry. One last thing. And this is even before this entire asset class being stress tested in a recession. It is yet to be stress tested. Yes, business development companies were around well before the GFC. So it's not like private credit is new, but this sort of iteration and vintage of private credit has yet to be stress tested in an economic downturn.
Yeah, these were loans that were made about 4 or 5 years ago during the glory days of 2021, largely to software, before the release of ChatGPT. Software was eating the world, and now AI seems like it's eating software. I mean, I think I can get a sense from what you said, but I'd love to double click on you saying, you're getting these deals pitched to you 10 times a week. Like, did you nibble on any? Or like, what was it about your experience that made you say, because it was such a hot market, for you to say no when you did, that's a difficult thing to do if you're getting, everybody's positive, everyone's saying the momentum is great.
So at the end of the day, private equity, private credit is just a levered long, okay? Private equity, they're buying a business and they're layering on leverage. That enhances their returns. Private credit is doing the same thing. They're buying, they're lending out money at, call it 6 to 8%, and they're levering up. So for every dollar of equity they have a dollar of debt at minimum, and some have more. And that all of a sudden, like magic, takes a 6 to 8% yield to a 10 to 12% type yield. Well, any individual investor can buy something on margin. I can buy a high yield ETF on margin. I can buy the S&P 500 on margin and not pay these private equity and private credit guys and gals these big fees and have a similar to better return. So I think investors should understand this. Now, not every investor is going to go on margin. But by giving money to the private people, you're essentially telling them to go on margin. So you're still essentially going on margin. So yes, it became the sexy asset class because the pitch was on private credit. Well, we'll get you equity-like returns, senior secured in the capital structure with much less volatility. That's what I heard 10 times a week. But again, there are going to be some underwriters that are going to be just fine because they're very diligent and they've been through cycles, and there are going to be other new kids on the block that were not as diligent. And one last point I want to make here with private credit. Most of private credit, and going back many years with the business development companies, all they did was finance private equity leverage buyouts. So you were lending into a levered entity that private equity LBO'd. That's what private credit mostly is.
Yeah.
Those are the loans you're making. I prefer the private credit side of those that are directly lending to businesses that are building a new factory, expanding overseas, adding a new conveyor belt in their existing factory, or buying a business. To me, and that you can do asset-backed, that is a much better private credit direct loan that I prefer than just financing somebody else's private equity LBO.
We're going to get into some of your top ideas, but before we do, I still have some kind of higher level questions. One big one, and that was a topic of much debate, well, it still is, what is central banks, central bank outlook, what's happening with interest rates? How much does that matter to your investors, like your outlook? I know I can spend a lot of time obsessing about dot plots and Fed chair changeovers, but at the end of the day, is it going to change your outlook?
It's not going to change mine, but I still have to pay attention because markets care.
Yeah.
But we have seen a big change, though, in terms of the influence that central banks have. For 40 years, when we had declining interest rates in response to declining inflation after the experience of the late 70s, early 80s, central banks had licensed to do whatever they want in response to whatever crisis came our way. Greenspan experimented with 1% Fed funds rate after the tech bubble blew out. Then Bernanke thought, well, hey, in response to the great financial crisis, we'll do you even better and we'll cut rates to zero. And then the Europeans said, hey, well, zero sounds great, but we're going to take it even a step further. We're going to go negative. And then QE in the midst of all this. Now, central banks were able to do this because of the issues, obviously, that the global economy were facing, but because inflation was very low. And then, of course, you had COVID. And then you had 2021, 2022, this huge inflation spike. And still to this day, inflation, it still remains rather persistent above the arbitrary 2% target that these central banks have. And that complicates, and now, of course, you have the rise in energy prices and further throwing mud into this inflation story. And central banks just have much less flexibility to deal with stuff. And even just look at the yield curve, and not just in the US, but around the world. The Fed has cut 175 basis points, and the 10-year yield is no lower than where it was in the summer before they started cutting, and is in fact about 70 basis points above the low point when they actually started cutting in September 2024.
Yeah, what is that about? I just want to pause there and explain what is that about? Because these rates, the bond market, the yield should be lower because interest rates are falling. Why isn't that happening?
Because the long end of the curve doesn't like inflation, and it still has it. I do think for the first time, debts and deficits in a lot of these developed countries finally do matter. And there is now a term premium that is built into the longer end of the curve in the US, in Europe, in Japan. And that investors are saying, okay, we're going to lend you money. We care about debts and deficits now. You're going to have to pay us a bit more in interest income. And I think that is a factor. I mean, look, the European Central Bank, they've cut their deposit rate by 200 basis points, and we have multi-year highs. I think the German bund yield last week got to a 15-year high. You have the 10-year 10-year UK gilt yield rose to the highest level since 2008, and the BOE has been cutting rates. And look at Japan. Japan, on the other hand, has been slow in raising rates, and the rest of the yield curve said, hey, BOJ, if you're not going to raise, we're going to do it for you. So 10s, 30s, 40s in Japan, JGB yields have shot up. And I think that matters now because what's going to come post-war? We're trying to think of what the world is going to look like. Well, you can be sure there's going to be much greater defense spending. You're going to have a lot of government spending that's going to help to try to cushion the blow of this jump in energy prices with respect to mitigating the impact on consumers. So debts and deficits are going to get even worse. And I think the rise in the long end of a bunch of yield curves around the world, it wasn't just an inflationary response, it was a debts and deficit response as well.
Does that mean you're not, what is your allocation to bonds? What's your recommendation there? Is that an area that you would recommend? Or it sounds like you think even with rate cuts, it's vulnerable.
So from a firm basis, we've been very much focused on the short end and not exposed really at all on the long end in terms of our duration. The portfolios that I manage, I've tried to also focus on short duration. And I've been very bullish on owning TIPS because I feel like the
These are
The
inflation protected treasuries.
Exactly. So prior to the war, I felt that the market was underpricing the inflation risks, and now, of course, has readjusted out to 5 years, less so out 10 years. And also, I've been very bullish on emerging market developing country bonds in local currencies. That got hit in March when the dollar rallied, but for the past year and a half, that trade has worked out very well with the weakness in the dollar. Uh, when we talk about debts and deficits, ironically, emerging countries have much lower debt ratios, much lower budget deficits, and I think are actually more attractive bond markets to be investing in. And if the dollar does reassert its downward trend, which I think it will when all things settle down here, I do think that is a great place for yield and also extra income, or I should say extra returns from a weaker dollar versus other emerging countries. I mean, you take Brazil, for example. Brazil has 11% real rates of 11% versus zero real rates. And actually now with the inflation jump, probably negative real rates in Europe, almost zero in the UK, 50 basis points in the US, and which will further shrink with this rise in inflation, and certainly negative in the short end of the curve in Japan.
And we'll talk about that because you got an ETF to play that in ProPix. You did mention defense, and I just want to spend a quick beat on that. Why did defense pull back when the war started?
I think investors are really becoming a bit more choosy on buying defense stocks because it really depends on what you're making. We're seeing what a new war looks like, and it's driven by drones and interceptors of those drones. So if you're old school selling fighter jets and tanks and aircraft carriers, well, drones have totally changed the makeup of that. And where a $2,000 drone can damage a multi-million-dollar plane. So I think that those that were sort of heavy on old war tactics have been underperforming. And on the private markets, where a lot of this sort of new technologies with defense, their valuations have been going up at the same time as U.S. classic defense companies haven't done what investors thought that they would do.
All right. Now let's get into some of the areas that you've got some high conviction, whether it's stocks or sectors, and we'll jump into your pro picks. ProPix is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, so we already know that you are bullish commodities. You want to express that in oil and gas. Even at $80 per barrel, you think these oil and gas stocks have a nice life. Something you alluded to, maybe we can expand on here, is the fertilizer sector and the underappreciated, perhaps, disruptions that have come out of the Iran war.
Yeah, so when we look back after Russia invaded Ukraine, we saw a previous spike in crop prices, as Ukraine is a big producer of them, and also fertilizer prices. And then as the war progressed and people realized that there really weren't any major supply disruptions, you saw big declines in both crop prices and fertilizers. So now you enter this war, and people quickly realized that particularly nitrogen, urea, which is a form of it, a lot of it is sourced in the Middle East. Also, natural gas is a major input in producing fertilizer. So we saw a big jump in fertilizer prices. Now, particularly with phosphate, because if you look at the three major fertilizers, nitrogen, potash, and phosphate, phosphate, two big inputs is ammonia and sulfur, or sulfuric acid. Well, the price of sulfur spiked, price of ammonia spiked. So for phosphate makers like Mosaic, that was actually a problem because their big inputs were spiking in price, where the price of phosphate wasn't going up enough to offset that. So it was really like the potash producers, the nitrogen producers, where I mentioned big supply disruptions in nitrogen, those producers, those stocks jumped, like CF Industries, which is heavily in nitrogen, that really went up a lot. Nutrien also did go up a lot, but Mosaic, which is heavy in phosphate, in addition to potash, the phosphate issues that they face, that stock didn't do as much. But I think generally the setup going into the war, it was these stocks were very depressed. I mean, corn at $4 a bushel, depressed. Wheat at $5.50 a bushel prior to this, depressed. Soybeans at around 10, depressed. So now crop prices have only gone up a bit, not as much as I thought, but that is also because the planting season has just begun, and we're really not going to see the yield repercussions from maybe less fertilizer planting until, call it October, November. But I think that's sort of the next leg to the commodity bull market, is eventually ag catching up. Now, if the war ends, sulfur prices go back down, ammonia prices go back down. I do think that phosphate prices are going to go back up, and Mosaic is going to be able to participate. But the way that we're playing the eventual, I believe, bull run in ag is through the fertilizer companies. Now, you can also buy Deere, that is reliant on farmer income eventually improving at some point. But that's another area of this commodity bull market that I think will eventually participate. Now, in 2025, we know it was precious metals and industrial metals that are going through their own digestion and consolidation and pullback. But, there are also still attractive areas there as well.
And the other sector, and this is so interesting, are consumer staples. And, we don't get a lot of people who recommend that sector, which I also think is interesting. It's a bit of a contrarian play. Your ConAgra brands, your Kraft Heinz, some are trading at multi-year lows. Why do you want to scoop them up here?
So this is by my own personal pain trade, because the stocks
we all
have been
have
really
them, don't worry.
Yeah, the stocks have been really difficult, and not just in multi-year lows. These stocks are at multi-decade lows, and we all know the challenges. They raised price too much post-COVID. It hurt volumes. We know that eating habits have shifted to more health and wellness, protein. The business is just more competitive as people are looking at just past the store brand, the well-known brands, and downshifting to private label and Trader Joe's and so on. But these companies and the management, they understand the situation that they're in. They're all trying to sort of reset their product lines, focusing more on protein, making using better ingredients, and less processed stuff in the foods that they produce. They're all adjusting to this new reality. And you take Kraft, for example, which has got a dividend yield of like almost 7% at this point. They were going to be splitting themselves up, but then the new CEO, Steve Cahillane, came in. He was the prior CEO of Kellogg's, and he said, "You know what?" He went to Omaha, Nebraska. He met with Greg Abel at Berkshire, one of the largest shareholders, and said, "You know what? Maybe we'll keep this thing together." And they're going forward by keeping it together, because for 10 years, Kraft lost market share because they were not innovating, and they were not investing in marketing and advertising their brands because of the LBO that was done. The Brazilian company, I think it was 3G.
Yeah.
And they said, we don't need to invest because these things will sell themselves. And they went that way. Well, that was a bad idea in a highly competitive industry. So Steve, I think, is refocusing a lot of their best brands and sort of segmenting the product lines into, we're going to heavily focus on our best brands. We'll invest somewhat here, and we'll wring the rest for cash flow. And I do think that there's going to be a turnaround here. I think he's going to do the job. And they still have phenomenal brands like Philly cream cheese and Heinz ketchup and Kraft macaroni and cheese. And I think that they've seen, when they do invest in some of their product lines, it really shows up. And these stocks have been left for dead, and they've been thrown out. I guarantee no one is going on TV, no one is going on a podcast and pounding the table on Kraft or Conagra, which reported earnings on the day we're taping this. That is the largest frozen food seller in the country and has a really nice meats business and beef jerky and Slim Jim. So I think that these CEOs, these management teams are getting it. And I think you're buying these stocks at dirt cheap levels. Sentiment that I see is at the bottom. And things don't need to be good for these stocks to work. They just need to be less bad.
This is my love language. I'm a sucker for these cheap stocks that everyone hates. And I don't know, maybe if they get this protein thing right, because I'm a woman of a certain age and I'm constantly, I'm not eating enough protein. And I'm starting to see cereals that have protein. So maybe that's going to be the next big craze. So we'll see how that does, because we're definitely going to track how that performs over the next year. I want to end with, you already alluded to this, emerging market local currency bonds. And there's actually a neat, tidy little ETF, the Van Eck JP Morgan ETF EMLC, that helps you play that. And I was actually kind of astounded to hear you say, if you're hawkish on debts and deficits, actually emerging markets, they don't have a lot of that.
Yeah, they have much better financial situations. And also they have monetary systems run by central banks that have many, many years of inflation fighting experience. And they never went down this, what I call dark path of negative, not only nominal interest rates, but but negative real interest rates. And I think when you are lending money to a government, now they're still emerging markets. I want to caveat it there, but as I mentioned, 11% real rates in Brazil, as an example, and I express it through local currency. That's taking certainly added risk and playing the FX markets. Investors can also buy emerging market bonds in dollars, where they don't have to worry about movements in the dollar. But that'll underperform when the dollar weakens. It'll outperform when the dollar strengthens. But
I was just going to ask how much of
markets.
I was just going to ask how much of this relies on a weaker U.S. dollar, because certainly this area of the market was hit in March. It did well going up to March, but was hit in March on U.S. dollar strength.
Yeah, this particular ETF was up in the mid-teens last year, helped by a generous coupon of, call it, 6.5%, in addition to the dollar weakness. And so, you're going to have to balance the generous coupon with, the volatility in the dollar. But, I want to own, we have plenty of dollar assets. So I think it's a nice mix to add some non-dollar exposure. And this is one of the areas that we're expressing it.
Peter, thank you so much for joining us and sharing your insights, and very timely given the current market conditions. I appreciate you joining us.
Thanks, Amber. Great to chat with you.
That's Peter Boockvar joining us at One Point, BFG Wealth Partners, the Chief Investment Officer. Don't miss our next episode. Well, maybe these cheap tech stocks are enticing enough for our next guest. If not Peter, we've got Kim Polton of Black Swan Dexteritas joining us. If you've got questions, email us questions@inthemoneypod.com, and we'll see you on the next episode.